Welcome to the Term Sheet Teardown webinar hosted by Finley, LegalScale, and Upper90. I have not fact-checked this, but this is, to my knowledge, the first assembly of debt capital software, legal and capital provider perspectives on term sheets ever. So a historic occasion. Thank you, everyone, for joining us, and we're looking forward to some great discussion today. And so just to kick things off, let's have the speakers, presenters, talk about their backgrounds and their experiences with term sheets, whether in their current role or in different contexts, and maybe wrap up with a fun fact about themselves or something interesting that they'd like to try in 2024. All right, thanks, everyone.
Hi, everyone. I'm Jeremy Tsui, founder and CEO of Finley Technologies. We provide software to streamline every aspect of the debt capital raise and management process. In a former life, I was a debt investor at Goldman Sachs, looking through these term sheets and kind of negotiating. And then, today we've worked with hundreds of finance and capital markets leaders to help them better understand what are the right things to look for in facilities and demystify the world of term sheets. So we're incredibly lucky to have partners like LegalScale and get to work with their clients, and as well as partners like Upper90 to help them work with their portfolio companies and transactions. So I'll pass it on to Mehak.
Perfect. Thanks, Jeremy. Hi, everyone. I'm Mehak Rashid. I'm a partner at LegalScale. My primary practice is finance, although I also do M&A. Prior to founding and growing LegalScale, I was at Morgan Stanley and at Davis Polk, also doing finance there. We do both borrower side and lender side, so I think that this topic is fantastic for not only for borrowers to try to get to learn about how to really read a term sheet and understand what they're getting into, but also for lenders to understand what their borrowers are thinking when they're going through this process. So we're really looking forward to it. We work with all sorts of companies from early stage to late stage, and all sorts of lenders from private credit funds, as well as direct lending or specialty lending funds. So like I said, really looking forward to meeting everyone and answering all your questions today.
Excellent. So I'll go next. Mehak and I are co-founders of LegalScale. We've been at it for 6 years now. I think that this, just like Mehak said, and I would second, this is just a fantastic program for prospective borrowers in the marketplace. What Mehak and I see time and time again is that borrowers, of course, need education, but they also need to think about how any sort of credit facility like this will impact, of course, the credit side of the balance sheet as well as the equity side. Because credit can be an amazing tool that can boost the returns of equity, but it could also be dilutive, and it could also give rise to issues. So I think that this is great, and so many of the borrowers that we see really can benefit from this instruction, and we're happy to do so. So I'm the leader of the equity practice and the fund formation practice at LegalScale, and we're really excited to be here. I guess as my fun fact, or what I hope to do this year, Mehak and I endeavor, of course, to build LegalScale into a mega firm and disrupt big law. But in a non-professional capacity, I endeavor to ride a monster truck this year. I try to do a different vehicle every year, so hopefully a monster truck is for 2024.
Awesome. And my name is Dallin Rosdahl. I'm a principal at Upper90. Upper90 is an early stage credit firm based in New York. We focus especially in the fintech areas, but we've also invested really across the economy. I've been in private credit for about 4 years now. I've probably closed and structured north of $500 million in transactions. And before that, similar to Mehak, I was at Morgan Stanley as well. Fun fact for this year, I would like to try backcountry skiing. So that's a goal for the year.
Sure. So now we're going to spend 5 minutes going through the term sheet that was circulated through email, and want to do this, just kind of get everyone on the same page, and also want to keep today as interactive as possible. So, attendees, we can kind of see y'all, any questions, anything and everything is fair game for panelists today, and we'll be monitoring the chat. So, Josiah, would it be easiest if I shared my screen or you? just gonna chat through the term sheet real quick. So. Great. So I can drive. Yeah. So today.
Yeah, no problem. I was just going to say, I will go ahead and distribute the link. It's a shortened bit.ly link to the term sheet in the chat. And then after that, I will go ahead and share on screen. And while we're doing that, let's quickly do the lightning round, where we ask the panelists to talk about the most common or biggest mistakes that they see borrowers and perhaps lenders making in term sheet negotiations.
Yeah, I'd be happy to take that first. So what I quite often see is when a borrower negotiates an ABL facility, they don't quite understand what the advance rate really means for them. So I've had this happen countless number of times where when we close the facility, and let's say that the advance rate is 80%, borrowers then don't realize that they need to get the other 20% in equity haircut capital by just having that cash on hand. And so then they're not able to actually deploy any of the commitments under the facility because they don't have the 20% to then add to the actual funding of the receivables. What I would really suggest is not only understanding the full implications of the advance rate on the overall calculation of the borrowing base and therefore the funding of the receivables, but also securing that equity haircut capital in tandem with securing the debt facility. You can't have one without the other. So you certainly need to make sure that you're able to actually deploy dollars from that debt facility on day one by having your, as lenders call it, skin in the game with that equity haircut capital.
Perfect. Just to go to piggyback off of that, and I think this is really relevant. We often see borrowers too, especially early stage borrowers that might have a more inchoate business, often trade away very substantial equity consideration to new lenders within their first credit facility. And so one thing that we've seen time and time again is that a company might trade away 10, 15% or more of the company, and they might do so on a fully diluted basis based upon the time of exercise. And we'll get into that in this term sheet explainer as well. But one key thing to keep in mind is that that has a dilutive effect now and in the future, especially if it comes into the capital structure on a based upon the exercise date. And so we would really recommend making sure that the credit facility is supportive of future equity financings and is a real tool to bring in equity investors versus something that they might be concerned with giving rise to dilution later.
And, happy to kind of build on all that, which, both Neil and Mehak's views I definitely agree with. For me, I spend pretty much every day, all day, structuring and negotiating deals, especially in the earlier stage, is businesses focus on interest rate, which of course isn't not important. However, I don't think it's the most important thing. And I think oftentimes founders get really zeroed in on that number. Boards care a lot about it. It, kind of can sometimes make or break a kind of deal negotiation. And I think what's much more important than an interest rate, which, typically is going to come down over time as a business scales, as it's able to basically graduate from maybe, family office capital to private credit capital like Upper90, and then beyond that, maybe to bank debt. So naturally the cost is going to come down. But, when I'm involved, I like to think that what's most important is finding the right partner that, sees the vision of your business is capable of being flexible, capable of being aligned, and capable of being incentivized to really help you grow your business. And yeah, I think that's a critical oversight that I often see in term sheet negotiations.
Yeah, for me, I think it comes down to being able to produce the data to fulfill reporting and covenant requirements. So one reason that we love partnering with the legal scales and Upper90s of the world is just kind of how they're partners in translating what's in a term sheet to actual business requirements or actions that finance leaders and capital markets professionals have to take. One kind of pitfall that we see is so oftentimes folks can really prioritize getting the deal done, which is the most important thing for the business. But then after they kind of sign the term sheet, you kind of have to foot the bill and actually produce all the financial metrics that need to be seen on a certain cadence to kind of be in compliance. So I think that kind of legal to business translation layer is just something that we like to get ahead of and get everyone on the same page, whether it's legal counsel, lender, or borrower. Awesome. So yeah, we're gonna quickly transition into a high level overview of the term sheet and then into Q&A. Everyone has the term sheet, so we'll try not to bore everyone, but just highlighting a few sections that that we believe kind of constitute the core or the skeleton of the term sheet. Today, I'll chat through 3 sections, really just, I'd call it facility structure. So who's involved in the transaction? What kind of transaction is it? What kind of transaction is right for the company? I put it all in the kind of credit limit section. Just how much money do I have available to me as a founder, as a CFO, and how does that translate to runway and growth? And then the last section I'll just chat through is, I'd call it rules, compliance, covenants. What's all the stuff that I have to keep top of mind to maintain access to my capital? So Neil, Dallin, Mehak, feel free to jump in if I miss anything. But for us, I would say, we've intentionally chosen an SPV transaction, which is pretty common for fintech companies, issuers, originators. And this is pretty important because it allows for certain treatment of any asset. It allows smaller companies to essentially be granted access to much larger amounts of capital if, rather than kind of just taking out a loan on their own or as a company. So this is not dissimilar from individuals taking out loans, or mortgages against property instead of personal loans. But you'll see this over and over again where we talk about, hey, what kind of borrowing entity is it? What kind of parent borrower relationship is it? And we can get into that more on in the Q&A as questions come up around the right way to structure your transaction from a legal entity perspective. Second, go ahead.
I was just going to add a little bit of color as well. Is the reason why it's set up as an SPV is so that the receivables that are being financed under this loan facility are sectioned off in that SPV itself. So it provides both visibility to the lender as to what the collateral pool is, as well as just a vehicle that owns and it acts as the borrower under that facility. So like you said, Jeremy, we can certainly get into this a little bit later, but that is typically set up as like a parent entity and then a borrower SPV that then is the holder and owner of all the receivables that are financed under this loan facility.
Perfect. Section 2, I would say everything that has to do with I would call it the economics of the facility. How much the facility costs, how much of the facility can I actually use? How long is this facility going to last me? Is it 6 months, 12 months, 18 months? If I'm planning, the capital strategy out for the next few quarters. So I would bucket a lot of those. Dallin seems like he's had his fair share of sleepless nights thinking about advance rates and borrowing basis. But I would say like anything with numbers oftentimes is the probably the most time consuming part of the negotiations and can influence how much capital you get and how expensive that is if you're a finance leader.
And one thing that sometimes we include on the advance rate, oftentimes I'm setting up a facility with the legal scale team, and it's, for a new product, for a new business. And perhaps as, data and performance improves, I'll often offer like a stepped up advance rate, which is sometimes you'll see where, if your receivables you originate continue to be current and, of good quality, that where I can, see an advance rate go from 80 to 85 or 85 to perhaps even 90. I think, as kind of Mehak started way back at the beginning here, pretty much always important for a lender to see equity skin in the game. So it's pretty rare if ever to see an advance rate really north of 95%, certainly not in an early stage business. But with good performance comes sometimes a higher advance rate, which is helpful, of course, from a dilution perspective and from a cash perspective.
Awesome. Thanks, Dallin. And yeah, you'll see advance rate, you'll see all sorts of different fees in this sample term sheet. And it's important for both sides to really take everything into consideration when thinking about risk and returns and cost of capital comprehensively. And so finally, if you just quickly scroll through, I would say the third kind of bucket I would place a lot of these term sheet sections in have to do with rules, so that borrowers and lenders stay kind of compliant to the spirit and the structure of the credit agreement. So that could be covenants, how often you need to report on accounting metrics to show that your business is healthy. It could be on representations and warranties. So, kind of borrowers attesting that they continue to be insured, or there's no crazy court cases or kind of judgments that are following a company. And then I'll end with this. Oftentimes, portfolio covenants probably end up being the most operationally intensive part of these credit agreements. When we're working with founders who ask, hey, what do I need to know about the administrative cost to kind of being in compliance over time? It actually often comes down to portfolio covenants where, if you're, kind of issuing a credit card or extending consumer loans, your view of risk and how you measure loss rates and even kind of store data on your customers oftentimes needs to be configured to basically the views of the Upper90s of the world, the other investors and banks. So, we will really guide founders to think long and hard about the rules they want to sign up for to report and making sure those are aligned from a systems perspective. So,
and these financial covenants, portfolio covenants, events of default, negative covenants are all the ways that a loan can go wrong. So it's really important to focus on these things, because if any of them are violated and there's no cure period or other ways to solve for the issues that arise, you can end up in a situation where the loan becomes callable, and then now you're stuck with having to repay the entire loan upon demand. So while we certainly want to focus on affirmative covenants as well for reporting and everything else, financial covenants and portfolio covenants and the negative covenants also become really important, not only for the reporting purposes, but also just to make sure that you are in compliance with the credit agreement and the restrictions that you have already delineated within the document itself. Great.
Perfect. So there's one question on the warrant, so I'd be happy to go through that. Or if you're going to open up to broader questions, that's fine too.
Yeah, I think go for the warrant now.
Cool. Yeah, that sounds great. So the warrant is just so everybody can keep track, is at the very end of this term sheet. And it's probably its own bucket in terms of considerations for the company, because it acts on the equity side of the ledger versus the debt side of the ledger. Of course, there's interplay. And so the question, just so everyone is on the same page, is how borrowers should think about warrants, which is a broad question, but one that we're really happy to go into. So first and foremost, especially for early stage companies, the legal scale team, the Upper90 team, we all believe that the warrants can be an excellent way to align interests between borrower and lender. The reason why is because it helps put the lender in the capital structure of the business, and there will inevitably be, just like for all investments, a J curve. things will go wrong, things will change within the business, and to incentivize the lender to think like one of the equity owners of the business becomes really important for an early stage company. It's not unlike mezzanine debt or something for later stage companies that also helps to equitize the lender so they think alongside of the other equity holders of the business. This warrant, one of the reasons that we included this language is it's a bit more dilutive than it seems. And so it's really important to consider exactly the terms that you're getting. And Dallin spoke previously to a myopic focus on interest rate and things to be aware of in terms of the borrower's perspective. Here, people tend to be myopically focused on the percentage. What percentage of the company are they getting? What piece of the pie? But just like anything, that percentage can be higher or lower based on the legal terms and the words around that percentage. So here we have 1%. That's actually a pretty good percentage. Within the market, we sometimes see 2%. We sometimes we can even see higher amounts, but we would say 1 to 2% would be in the standard range for this facility. And thank you for highlighting that. In this case, we're covering all, and exactly within the highlighted language, we're calling all of the fully diluted equity. So even if you have a warrant, a safe, a convertible note that won't come into your capital structure yet, we're still going to need to take that into account when we determine that what that 1% is based off of. So if you have 1 million shares issued and outstanding, but then your convertible note and other instruments will convert into another 2 million shares, so that there would be 3 million on a fully diluted basis, that 1% wouldn't be for 10,000 shares, but 30,000 shares. And so that fully determined versus issued and outstanding is a really important component of the analysis. The next is, what will that 1% convert into? Will the warrant be exercisable for preferred stock or common stock? So here we have the most senior class of preferred. And so that means that for future equity rounds, until this warrant is converted, and as we can see within this term sheet, it will be outstanding for 7 years, you'll need to keep 1% of the preferred stock so that warrant can convert into it. So if you issue 1 million of Series A preferred on some future time point to the incoming preferred investors, that would need to be 1,010,000 to make sure that this warrant is convertible into that share class. So Upper90, for example, is a very friendly lender. They often don't use language of this type, but Mehak and I work with other lenders that do use this more aggressive language. And it's one in which, from this point, you've gotten a very good percentage, but the other terms around this would make it a more dilutive instrument because it will sit higher in your cap stack. It will be preferred stock, the most senior class preferred upon conversion. And we're going to need to take into account all of your cap table when this warrant converts.
Dallin, you wanna take the next one on kind of
Sure.
stage and considerations?
Yeah, exactly. So, I think I highlighted earlier, as oftentimes a company becomes later stage, scale increases, of course, needs change, you can often attract a bank, which obviously has a lower, basically a deposit base as their kind of cost of capital. So that, kind of is a more obvious one. Maybe one that's more interesting is I think that, for an ABL specifically, as a business gets to a later stage, you may see a more of a preference by a lender for a bankruptcy remote SPV, as opposed to having a parent guarantee. To kind of give a quick 10 seconds on the parent guarantee, it's a really important tool, I believe, at an early stage, just to ensure there's alignment between the new company, the product you are financing, and you as a lender. But over time, and Mehak kind of touched on, having a separate SPV with receivables, like if that SPV is BK remote, that lender may actually be more comfortable knowing that in the event that, things go south, they can actually kind of put their arms around their collateral and kind of be absolved from any sort of Chapter 11 disruption to their effectively their liquidation and their recovery of their principal. And beyond that, I think all the economics are really just kind of vary based on back to the cost of capital inherent for the capital provider. I do think you're going to see covenants, whether it's an earlier stage deal or a later stage deal. And look, I think obviously to Mehak's point, it's important to understand what you're signing up for. It's important to understand, like, hey, I'm agreeing to this minimum liquidity amount or this tangible net worth amount, and understand that I can perform above that level. But also, like sometimes I've found that borrowers get really turned off by the presence of covenants, and they really go out and seek a cov light or a no covenant deal. And I think that, you know, covenants are obviously designed to protect the lender, but I actually view them as a way to protect the borrower as well, because really, you know, covenants are something you agree to up front. This is how things are going to go. And if things don't go that way, the first step of, you know, most lenders, especially at an earlier stage, is to, you know, come back to the table and sit down and discuss and find a way to remedy and solve the issue. And so covenants, I like to think of them as guardrails to kind of create discipline and kind of chart a path for success for both the borrower and the lender.
To add a little bit more as well down to the question of what changes between an early stage company and a late stage company, is that a late stage company might already have other debt in place. A lot of companies don't really think about that when they're trying to get a full credit facility, but to the extent that you already have, let's say, like notes from friends and family that are outstanding, we've seen that quite often, or even another, you know, working capital facility in place, and you're trying to get a full ABL facility, you certainly need to make sure that the lender is aware of the existing debt and that you're able to maneuver that into the new facility, build in the proper allowances within the negative covenant baskets, like the debt basket, liens basket, things like that. Or a lot of times what lenders ask for is the payoff of the existing debt. And so what what borrowers need to think about is, do they have enough capital, not only from what they might get from this new lender, but from cash on hand, in order to then pay off existing debt and then refi into the new larger ABL facility. So that might not be a consideration for early stage companies, but it certainly tends to be a consideration for later stage companies.
All right, the next question is, how should borrowers identify the best lenders to engage with? So I'll kind of let different folks give their plug, but from our point of view, it all comes down to borrowers finding lenders that can help them reach their business goals, which typically comes from, hey, has the lender worked with similar borrowers before and help them succeed? Practically, we see this take a few forms. Depending on what type of borrower it is, it could be venture backed, it could be non-venture backed. We'll see the best lenders tailor the term sheet to the type of borrower. So one example would be, you know, if you're a lender and you kind of underwritten similar borrowers before, you'll put certain portfolio covenants or financial covenants that make sense for that borrower. On the other hand, if you have never underwritten a credit card company or consumer lending company, you might put the wrong covenant, and then the borrower comes back on the first turn of the term sheet and they're like, hey, this is actually like not super relevant to my business. So that can be a kind of a telltale sign of which lenders have experience in your industry as a borrower.
I think that's spot on, Jeremy. I think really finding a lender that understands your space, understands your business, it's going to add a lot of that lender is going to add a lot of value in addition to the capital they provide as they help you think through, you know, key decisions and structuring and, you know, your underwriting manual that you're working on to originate receivables, whatever, like all that, like, you know, those reps that lender has will accrue to your benefit for sure.
Something Dallin actually said earlier too is, the lender is going to be your partner going forward. That you want to work with somebody that you know believes in you and can provide support to you. Say, for example, let's say for 1 month or quarter, your financials aren't as strong as they should have been, or you need some relief on the covenant side. You want a lender that understands that and is willing to give you that relief for a short amount of time in order to continue to operate the company, and doesn't act as, the word is thrown out a lot, but like a vulture lender where all they're looking for is to just get immediately call a default and take over the loan and take over your company. You don't want to work with people like that. So that also just comes from talking to people as great as Dallin here on the Upper90 team and a lot of the other lenders that we work with. But You want to build that relationship. That just comes from talking to people, from having these conversations. And frankly, as soon as you connect with somebody and you have those conversations, it'll be easy to tell.
Neil, you want to take this next one?
Sure. So the next question is, that I see is it better to work with law firms or legal service providers? Perfect. So, from our perspective, there's a clear differentiation in the market. And whether or not you use legal scale, which of course we love, other legal service providers really would be inappropriate for entering into any debt facility or to complete an equity financing. These items tend to be very bespoke, and you want a large law firm and one with experience in order to assist. So people that sometimes we hear, I use LegalZoom, can I continue to use them or somebody else? Or I have a friend that's just graduated law school that has helped me part-time to assist with that. These are the key foundations of your business. And one of the reasons that Legal Scale always focuses on financing transactions is that there's a mission critical nature to these financing transactions that's really important to consider. And so, from our perspective, you want somebody that's incredibly experienced and knows exactly what they're doing and knows the market and can be a good resource, especially from the prospective borrower side. One thing that Dallin has developed by virtue of doing hundreds of deals is a great ear for the market. He knows exactly what's going on. He knows where terms sit. For prospective borrowers, they're in the market less. And so, to get Mehak on your side and to say, oh, what are you seeing right now? What are interest rates, fixed or floating? All those things are incredibly valuable and reasons why you want to use a law firm and one with a lot of experience for any financing transaction.
I think the next question actually might also be good for Neil to answer.
Sure, yeah, I think the next one's really, that will pivot to Mehak as well. So how should startups communicate the progress on their debt facilities to equity investors? So first and foremost, equity investors should be looped in at each time point. The major equity investors in the business are often board members. And so you should, and even if not, they're still a critical component of any financing. NVCA standard, North American Venture Capital Association standard documentation includes protective provisions, which virtually always include a requirement that shareholders vote on debt. Debt rises above equity, and so it can be dilutive if the terms aren't agreed and if it's not a perfect facility for the company. And so in the first instance, your shareholder base will need to vote on the debt facilities that you're entering into, especially if it's a large debt facility like the term sheet that we presented here. And so we would say to check in with equity investors early and often. It might be in the form of bullet points or some other progress that you're making. We often wouldn't share the entire credit facility with them. Mehak's world is harder than mine. She's working on 200-page documents, sometimes more. But you still want to let them know the key commercial terms, where things sit, how long you think it will take to negotiate, and things like the equity haircut or future dilution to the business are all really important to consider and to stand up. It's probably something that you want to discuss on your regular board meetings, and then with like a quarterly call to investors or however you're communicating with them. In those regular communications, you're going to talk about entering into a credit facility, the status of the credit facility, exiting from and refinancing the credit facility. All those touch points are really important to do, and we would encourage having them on any board call.
And sometimes, we recently closed a very large transaction that had both a debt facility and the Series A at the same exact time. So not only did we have to continue to communicate with the equity investors about the debt facility, but we had to make sure that those get closed in tandem. So you might see in your own debt facilities that there might be a condition to closing that's predicated on an equity raise, whether that's dollars in through safes or an actual price round. So even in that scenario, the communication to investors becomes even more important than otherwise a regular way communication.
Great. And the next one's legal too. Mehak, do you want to take it first?
Sure. So the next question is, these facilities can get expensive to stand up. Is it market to negotiate a legal cost cap? Any other tips or tricks to keep things on a budget? We totally understand that. That comes all the time. So what we've done previously is certainly negotiate, especially on the borrower side or vice versa, is negotiate a cap on legal expenses. It is a double-edged sword. So sometimes what we see is if you negotiate too low a cap, then what ends up happening is you just get take it or leave it docs. So you get a first set of documents and there's no room, the lender's just gonna say, here are the documents, you don't want more legal spend, so just take it or leave it. That's not great for the borrower side, because it puts you into a situation where you might not be able to negotiate the best deal for yourself. And so we don't want to be penny wise and pound foolish. We certainly want to make sure that you're getting the deal that, and the difference here is debt lasts for a long time. So if you have a year facility, 3-year facility, 5 years, 7 years, you want to make sure that this is a living document that you can actually live with. So while having said that, I know that it would be a hard pill to swallow if the legal expenses get out of hand as well. So there's a happy medium in between where you can figure out a good, reasonable cap and offer that and work with the lender. You can get an estimate from the lender's legal counsel as to how much this would approximately cost with some assumptions here and there. But it is certainly okay to, put some sort of cap or a limit on deposits and things like that.
I'm happy to take the next one on venture debt. So the question is, can you give some advice on how to think about negotiating an ABL when you have a venture debt line at the top co as well? The obvious first step is to engage with that, lender at the parent or at the top co first. The most likely additional indebtedness in an ABL will be, need to be permitted by that venture lender. So I'd start there. Communicate, the intent, what you're looking for, the, new assets you'll be financing. And I think pretty typical, a venture debt lender will allow that to happen with a small amendment, but I would start there. And then I would just kind of think more broadly about, when is the right time to raise that ABL versus fund some of those new receivables with equity. Many lenders, they're coming in, there's already indebtedness on the business, and their collateral effectively is just the specific assets they're financing. Like they're going to want to have a little bit better understanding about the actual kind of quality of those assets. So that may be something to consider as well as you're thinking about raising an ABL after having a venture debt in place already.
And it might even be a good scenario where if you did end up setting up that bankruptcy remote structure that Dallin was talking about earlier, and you have the debt at the parent level, because your new facility is going to be at the borrower level that will be separate and apart from the parent, you might be able to put those two in place together, and or rather put the new facility in place and keep the facility at the parent level in place. Everybody obviously needs to be aware of what's going on, but the new lender coming in at the borrower level will find comfort with the separation between the borrower and the parent with the bankruptcy remote structure. And the parent lender will also be okay because now they're getting additional credit support to then create additional receivables at the subsidiary level. So should things go awry, they'll get the residual benefits after the borrower lender is paid back and that facility goes away. They'll get the residual up at the parent. So it's a really good conversation to have, and it's not uncommon to continue to have both two separate lines of debt at both the parent and the borrower level.
Matt, do you want to talk about the next one too? How many term sheets should borrowers try to obtain?
1 million.
Just one, just mine.
From Upper90.
Just 90, yes, that's right.
No, it's always good to, shop around the market. I think, part of what happens as well, you don't want to get too far down the pipeline with too many players because it's just going to spin your head. What you really want to do is weed out from the beginning, like we were talking about previously, just lenders that aren't a fit for you. So lenders that might not have the right rates or have too many fees or otherwise just don't understand your business and might not be good partners for you. So that is an early stage trash process of just going through all the term sheets that you get. I would say that after that, it's really anywhere between 1 and 3 term sheets you want to start really focusing on. And once you get to the point at which you're really certain about one potential lender, just really go all in and move forward from that. It's just gonna waste your time. You don't wanna drag out too long of a term sheet process, because it will hinder how quickly you can get a facility in place. You know, a question that I get quite often is, how long does this take? So typically, you know, the term sheet process, and Dallin will have much more insight on this than I will, but the term sheet process tends to take at least a few weeks. So once that's in place, then the whole credit facility, depending on the degree of complication, it might take anywhere from, you know, 6 to 12 weeks. So again, if we delay the term sheet process too long, then now you're tacking on an additional process for the documentation, and you might not end up getting the facility in place for, you know, anywhere from like 4 to 6 months, which might not work with the projections that you have for the company. So it's important to weed out things early on that don't really matter for your business, and then really start to hone in on the lenders that would be the best fit. Dallin, anything you'd like to add there?
No, I totally agree. Term sheets take a few weeks to negotiate, quickly identifying. I think we talked about earlier where Jeremy was mentioning, like, if you see terms that don't fit in a deal, just kind of toss those lenders aside and find those that are most serious, understand your business, because you know, each lender is going to have, you know, multiple investment committee decisions, credit committee decisions. So the quicker you can identify the right partners, the better for your own sanity's sake. And I'm happy to kind of dovetails well into this next question on like who I'm typically kind of negotiating and dealing with as a lender on the borrower side. At a minimum, for sure, the head of finance or CFO is always a part of those conversations. And oftentimes at the earliest stages, because I think Mehak called this like such a critical, you know, piece in a business's journey, especially ones that are asset intensive, the CEO and be involved as well. Excuse me, that's not abnormal at all. So I mean, of course, if you're on the borrower side, you're going to want to keep, you know, hopefully the right amount of cooks in the kitchen, but having those kind of two critical, you know, decision makers involved is probably in your best interest.
Excellent. Next one should be down.
Yep, and then this next one, I mean, look, I think, you know, my underwriting process is pretty extensive, but you know, oftentimes for me, you know, how I see a deal matters almost the most in my process. Is like, why am I so lucky to see this opportunity? You know, am I the lender of last resort, or am I seeing this because, you know, Jeremy ran into somebody and he thinks this could be a really interesting fit for Upper90? So I think for me, like, the source of a deal honestly is probably the most important part, among, of course, a number of financial and operational metrics that I look at in DD. I'll keep going. So the next question is, do lenders require a quality of earnings report and audited financials? It really depends. You know, oftentimes if I'm working with a Series seed company, they haven't audited their financials yet. I may give them, you know, a year or two. Maybe the first year I want them reviewed. Maybe the second year I want them audited. I think that's good hygiene. You know, we talked about earlier, you know, graduating to lower cost of capital, having third-party reviewed or audited financials is often a go no go for those lenders. So that's typical. And quality earnings, kind of same thing. You know, again, if the financials are completely internally prepared and I'm underwriting the business, that is probably something I would insert into the, you know, due diligence process for me to close the deal, would be a quality of earnings.
All right, lightning round. We got 2 minutes. I got one other question fed to me. What term sheet trends are we all anticipating for H1 of this year? Look into your crystal ball. Look into your big internal model.
I think an obvious one is going to be maybe a move back to fixed rates. Over the last few years, you've seen everything floating as the Fed has been raising rates. Now with rates coming down, lenders are going to probably try to lock in, you know, the current return versus see their margin or their spread on a risk-free rate go down.
On the equity side, I think that we will see, we talked a lot about a warrant, and the warrant will remain a key component of the investment package, but I think we're also going to see an equity investment letter or the capacity for the lender to lean into future financings at their discretion. So not only will they be equitized through the warrant, but then we'll have the right to get, in often cases, above their pro rata percentage of future financing, so that they can lean into winners. That's one thing that I think Upper90 is an extremely good job at, and some of our best hybrid funds that invest in both debt and equity, is that they can see the companies that are performing really well and then lean into future financings.
I think one other thing I anticipate seeing a lot of is just more collateral support. So I'm seeing not only the collateral of the borrower itself, but then also additional guarantees coming in from not only parent guarantees, but then maybe even personal guarantees. I almost always see a bad acts guarantee, but I'm seeing more and more of just additional collateral being provided as support for the loans themselves, especially as loans continue to grow in quantum. So I'd be interested to see how that grows within the bankruptcy remote context because of the inherent inability to get that parent guarantee. But we are seeing a lot more personal guarantees on the plate, which is very important for early stage companies to consider because it is the founders themselves that would be putting their names on the line. And of course, as the name itself implicates, personal guarantees are very personal. So, you know, you want to ensure that it is something that you can provide, but I do think that I'll be seeing more of those this year.
All right, with that, we will wrap up. Thanks, Mehak, Neil, Dallin for being panelists, and then just everyone for attending today and spending the afternoon with us. We will circulate the recording in short order, and yeah, thanks again.
Perfect.
Thank you
Thanks,
so much.
everyone.
Thanks,
And
everyone.
don't hesitate to reach out with more questions. Thank you.
Thank you.